Dear traders, welcome to From Zero to Hero project, 21 steps to being a super trader. Before we begin, there is a quick disclaimer explaining that Forex trading is leveraged product and can result in losses that exceed your deposits. This presentation is for educational purposes only, and online education materials are developed by Admiral Markets Estonia for a global audience. This video is not part of the .co.uk website, but the globalnews.com website. My name is Nenad Kerkez, and today I will show you what Forex market is and give you an introduction to Forex trading. The first part will explain what are financial markets overview, what are stock exchanges, why does price change, and how do supply and demand influence price. So financial markets overview is a bit easy to comprehend, and this is the overview over available financial markets. So first of all, we'll focus on Forex market. The foreign exchange market is a global decentralized market for the trading of currencies. This includes all aspects of buying, selling, and exchanging currencies at current or determined prices. Commodity markets are maybe one of the oldest forms of trading in the world. Thousands of years ago, men were already trading basic commodities markets like wheat and gold in markets around the world, from ancient Egypt to China. Nowadays, commodities include agricultural products such as corn and wheat, energy products such as oil and gas, and of course base and precious metals including gold and silver. Index CFDs are contracts which deliver the return of a market index. CFD is effectively an agreement between the buyer, you, and IB to exchange the difference between the current value of an index and its value at a future time. And it's because the underlying asset in the index is equities. So we call it also equities. Trading shares as CFDs means you don't own the underlying asset, but you can still speculate on the price of that company. So before trading shares as CFDs, it's really important to research both the company and the industry it is in. And finally, bonds. Those are essential loan notes issued by businesses and governments to raise money. But unlike shares, bonds do not result in any equity changing hands, although they can be exchange traded and offered publicly. So, well, we can say that bonds are more akin to the deposit-taking activities of banks insofar as the issuer offers a guarantee to an investor to pay back the face value plus interest at some defined maturity date. We will be focusing on currency trading and equities due to high intra-market correlation. It's also very important to explain what are stock exchanges. Well, we can say that a stock exchange is a market in which securities are bought and sold. So effectively, that is a clearinghouse that enables buyers and sellers to match their trades. You need to know that financial institutions provide liquidity, but exchange enables buyers and sellers to match their trades. Now, electronic communication network, or ECN, is the most important for Forex traders. Since a ECN broker integrates price quotations from several participants in the market, it can offer its clients tighter ask-bid spreads that wouldn't otherwise be accessible to them. By effectively using ECN, you will be able to trade with extremely low spreads. Now, because spreads in ECN are much narrowed compared to those used by everyday Forex brokers, ECN brokers such as Admiral Markets charge clients an established commission on each transaction, and that is a very low commission. Now, ECN connects buyers and sellers directly. So that is a huge advantage to you, a trader. And just final say for stock exchanges, there are 4 largest exchanges in the world: New York Stock Exchange, the National Association of Securities Dealers Automated Quotations, or NASDAQ, London Stock Exchange, and Tokyo Stock Exchange. If you want to trade currencies and make money, you need to know what is base and quote currency. So base currency is a basis for a transaction. So if you buy, the exchange rate shows how many units of the quote currency you should pay for a unit of the base currency. If you sell, the exchange rate shows how many units of the quote currency you should get for a unit of the base currency. Buy when you think that the base currency will appreciate versus quote currency, or sell when you think that the base currency will depreciate versus quote currency. So in this example, euro is the base currency, dollar is the quote currency. Have in mind that quotes have always two ISO designations. If you want to buy a currency pair, in this case euro dollar, you will actually, we say, go long on euro dollar. If you want to sell euro dollar, then we say you will go short in euro dollar. So effectively, in forex trading, you are able to trade both directions. You can buy pair, you can sell pair. It's based on your technical analysis and the system. Probably some of you are asking, why does price change? Well, there are a lot of factors. There are fundamental factors such as major and minor economical data throughout the week and each day. Then there is interest rate, politics, microeconomics, major economics, commodity prices, geopolitical effects, and of course technical factors such as supply and demand. And that is the domain of technical analysis. Also, there are main market players who move the market. We say those are usually big banks and institutional traders. But there are also retail traders such as us or you, hedge pension funds, central banks, corporations, governments, and remittance companies. Now, let's start dissecting the biggest players, and those are the banks. Though their scale is huge compared to the average retail forex trader, their concerns are not similar to those of retail traders. Well, both retail traders and institutional traders, of course, and banks seek to make profit out of being involved in the forex market. But the main thing, guys, is that actually banks move markets. So there are hundreds of banks participating in the forex world. Whether big or small, all banks participate in the currency markets not only to offset their foreign exchange risk and the risk of their clients, but also to increase wealth of their stockholders. Each bank, although differently organized, has a dealing desk that is responsible for order execution, market making, and risk management. Accounting for the majority of the transacted volume, there are around 25 major banks such as Citibank, Deutsche Bank, UBS, Royal Bank of Scotland, HSBC, Barclays, Merrill Lynch, JP Morgan, Chase, ABN, AMRO, Morgan Stanley, and so on. And they are the top of the food chain in the forex market. Also, we need to mention different corporations because corporations also trade between themselves, and they have influence in forex market. Well, not all participants have the power to set prices at market makers, but definitely corporations make up a substantial allotment of the volume being traded in the market, and that is the case of companies and businesses of any size, from a small importer or exporter to a multi-billion-dollar company. Central banks are maybe the top of the top because they hold foreign currency deposits that are called reserves, also known as official reserves or international reserves. This form of asset that is held by central bank is used in foreign relation policies, and it indicates a whole lot about the country's ability to repair their foreign debts and nation's credit rating. It indicates a nation's credit rating. By intervening on forex market, central banks are able to instantly move price for a lot of pips. What is a pip? That will be explained in future videos. How are transactions facilitated? Well, at the very top of the Forex market ladder is the interbank market. Interbank market is composed of the largest banks of the world and some smaller banks, the participants that trade directly with each other or electronically through electronic brokering services, so-called EBS, or Reuters dealing spot matching. Now there is also a competition between the two companies, but the good thing is they offer trading. Usually for the EBS platform there is euro dollar, dollar yen, euro Swissy pairs, but for Reuters platform there is GBP dollar, euro GBP, dollar CAD, New Zealand dollar, and those are most liquid. So all the banks that are part of the interbank market can see the rates each other is offering, but this does not necessarily mean that anyone can make deals at those prices. So interbank market is internationally connected network of all banks, portal, those Reuters, EBS platforms that allows us to actually trade. Now we need to distinguish between dealing banks, prime brokers, and retail brokers. Dealing banks are banks, of course, that are main market makers in Forex and the interbank market, and it represents the core of whole market. The individuals dealing currencies at the bank are called dealers. Prime brokers, on the other hand, are companies or firms that offer liquidity, leverage, and supporting services to other market participants. Most major banks have prime brokerage operations, but there are also non-bank prime brokers active in the business. The clients of prime brokers are usually other institutional participants, but in some cases an individual trader can also use a prime broker if he meets the requirements set by the broker. Usually there is a huge amount of money. And finally, retail brokers are brokerage companies that allow retail traders to access the Forex market. They can be market makers, STP brokers, or ECN. Market makers usually will take the opposite side of clients' trades and basically acting as dealer, not a broker. STP brokers, that means trade through processing brokers, direct most of all orders directly to the market, while ECN broker allows you to trade with various other participants and the broker has no conflict of interest at all. It's in the main interest of ECN and STP broker that you make money, guys. And that is the fact with admiral markets. As with everyday life, making money or pips in Forex market is actually a competition between supply and demand. Well, why I say competition? Because supply and demand will influence price at various ways. Now, supply is the amount available at a particular price, while demand is the amount that is wanted or desired at a specific price. Now, the law of demand states that the higher the price, the lower the quantity demanded. The amount of a good that buyers purchase at a higher price is less than. And as the price of a good goes up, so does the opportunity cost of buying that good. So as a result, we have naturally avoid buying a product that will force us to forego the consumption of something else we value more. So generally all the people will avoid buying if definitely it forgoes the consumption of something else that they value more. So that is the law of demand. The law of supply is different. It demonstrates the quantities that will be sold at a certain price. But unlike the law of demand, supply relationship shows an upward slope. And that means that the higher the price, the higher the quantity supplied. So, as an impact of a law of supply, we will have producers supply more at a higher price because selling at a higher quantity at a higher price will increase their revenue. Now, we know that price should gravitate to equilibrium level. When supply and demand are equal, the economy is said to be at equilibrium. But at this point, the allocation of goods is usually most efficient because the amount of goods being supplied is exactly the same as the amount of goods being demanded. So everyone, being individuals, firms, or countries, is satisfied with the current economic condition. So at the given price, suppliers are selling all the goods that they have produced and consumers are getting all the goods that they are demanding. So that is equilibrium level. But well, not always the price is in equilibrium, and that is when we forex traders actually want to come in terms with forex market. We want to sell high and buy low. So a point where the market has made a sharp decline is so-called supply zone. Okay, when we see that market is making a sharp upward bounce, it's actually a demand zone. So the main premise of supply and demand trading is when the market makes a sharp move up or down, the largest institutions such as banks and hedge funds, usually they are not able to get their entire trade placed into the market, so they leave pending orders to buy or sell at the zone. And that exactly moves the price because they are defending supply and resistance zones. When we follow the banks, I call them sharks and we are fish, we are effectively follow the trend. And don't forget that big institutions, those market movers, as I explained a couple of minutes earlier, they make trends. So when you make money, you should follow a trend. There is an old adage saying the trend is your friend. And that is exactly true because the shark is the biggest player in forex market, the biggest force in forex market, and you are the fish and you are following the shark. So market will always come to you, shark will always swim through water, and you will eat the remnants of a shark, effectively making money and pips. So this is the basic of forex trading. Trend following methods state always sell high and buy low. So for future information, you can always contact us at +4402 077264003. Email is helpme@admiralmarkets.com. YouTube channel youtube.com/admiralmarkets, and don't forget to follow us on facebook.com/admiralmarketsglobal. I will talk to you soon in lesson number 2. So take care, cheers, and trade safe.